The stock market is currently closed for the weekend. BigBear.ai Holdings Inc., trading under the ticker symbol BBAI on the New York Stock Exchange, finished its last active trading session on Friday, May 22, 2026, at 4 p.m. Eastern Time at a closing price of $4.18 per share. This represented a slight intraday decrease of 0.48% from its opening price of $4.22, while the broader trading session saw wild fluctuations, hitting an intraday high of $4.59 and a low of $4.11 on a massive trading volume of 65.60 million shares, which significantly outpaced its recent average daily volume. After-hours trading activity indicated a tiny fraction of continued movement, slipping an additional 0.21% to sit at $4.17 as the weekend pause took effect. While the immediate surface data looks like just another choppy day for a volatile small-cap technology name, what the general market completely overlooked in Friday's heavy volume was a massive accumulation pattern by institutional desks hiding beneath the retail volatility. While public attention remains fixated on hyperscale tech firms and massive chip makers, a quiet relocation of defense data infrastructure is occurring behind closed doors, specifically within specialized federal branches that cannot legally use open-source public models. BigBear.ai recently locked in roughly $75 million in fresh defense and Federal Aviation Administration contract wins, expanding its total corporate backlog to $281.9 million, a sudden 14% surge that completely changes its revenue visibility for the next 2 fiscal years. Most retail investors are watching this stock thinking it is just another speculative vehicle riding the coattails of the broader software sector, but the actual data shows a business that is structurally transitioning from a volatile government consultancy into a recurring software enterprise with defensive government backing. The common narrative surrounding BigBear.ai is that it represents an incredibly risky, cash-burning entity that cannot survive without continuous equity dilution or high-interest debt. The market looks at its historical net losses, the intense short interest currently sitting at a whopping 25%, and assumes this company is bound to follow the path of failed technology startups. It is easy to see why that perspective exists when you look at the older financial reports, but the reality is that the market is applying a traditional software evaluation metric to an asset that behaves much more like a locked-in defense contractor. When a company manages to narrow its first quarter losses down to 12 cents per share compared to a 25-cent loss from the same period last year, while simultaneously beating top-line consensus estimates with $34.4 million in quarterly revenue, the underlying thesis begins to shift. Investors who are self-investing or looking for investment help on various investing sites often look at the headline net loss figure and run away, failing to realize that gross margins have quietly recovered back to 34% due to better operational efficiencies and automated deployment strategies. If you look at the daily trading swings and the macroeconomic pressures impacting the small-cap tech sector right now, the tension between what people expect and what is actually happening becomes incredibly clear. High interest rates have historically crushed speculative technology stocks because their projected cash flows are pushed far out into the future, making their present valuations contract severely. However, when you analyze the institutional activity surrounding BigBear.ai over the last few weeks, big money desks are treating it as a geopolitical hedge rather than a risky growth play. Global defense budgets are expanding rapidly, and federal agencies are realizing that physical hardware is only as good as the predictive software directing it. This specific macro tailwind explains why the stock recently found a hard floor around the $4.10 mark and aggressively fought back toward $4.50 during midday trading before settlement. Retail traders utilizing a Robinhood app, a SoFi trading platform, or a Fidelity mobile app have been trading this asset with extreme short-term mindsets, resulting in the massive 65 million share volume spike we just witnessed. This short-term trading mentality creates immense friction with the long-term institutional accumulation occurring in the background. Large institutional funds do not buy their positions all at once on an individual brokerage account. They use algorithmic accumulation methods to scoop up blocks of shares when short-term traders panic during an intraday dip. The 25% short interest provides a massive underlying layer of technical tension because if the company continues to stack federal wins and clear its near-term resistances at $4.20 and $4.46, those short positions will face severe margin pressures, potentially forcing an explosive short squeeze toward the 200-day moving average. Let us pause for a second to look at how this company actually functions under the hood, because understanding its business model is essential to determining whether the current valuation makes sense. BigBear.ai operates heavily within high-consequence decision environments, which is a professional way of saying they build software for situations where making a mistake means catastrophic failure. They do not create mass-market consumer apps or creative generative tools. Instead, they sell highly secure decision intelligence software, data engineering systems, and machine learning models to the United States Department of Defense, the intelligence community, Homeland Security, and select commercial supply chain logistics operators. Their technology allows complex, fragmented, and highly classified datasets to be combined into a single operational interface, giving commanders and logistics managers real-time predictive analytics to optimize routes, identify vulnerabilities, and execute mission plans. When they acquired Pangiam, they aggressively expanded into digital identity and biometrics, allowing them to capture global trade and travel security workflows, which explains their recent landmark cargo security deal in Panama. To put this into a broader perspective, we should look at how this ecosystem compares to what else is available out there for modern investors. If someone is looking to invest online, they might rely on automated solutions like Schwab Intelligent Portfolios or a generalized SoFi robo-advisor to handle their capital allocation across broad index funds. Those platforms are fantastic for steady, long-term wealth accumulation through diversified vehicles like Fidelity ETFs or broad individual equities. But when you move away from automated management and step into the arena of self-investing through an interactive brokers platform or a Robinhood stock trading setup, you are forced to analyze individual corporate structures. A company like BigBear.ai cannot be evaluated through the same lens as mega-cap tech giants. It requires an understanding of government procurement cycles, federal budget lines, and technical defense backlogs that do not show up on a standard consumer stock screener. Comment below how many shares of BigBear.ai you currently hold in your portfolio right now, or if you are avoiding this microcap volatility altogether. When you compare this entity to the rest of the market landscape, the valuation contrast is stark. Think about how the market prices mainstream giants. Investors pile into Nvidia stock because they want exposure to the underlying hardware powering global compute infrastructure. They buy Apple stock because of its massive consumer ecosystem and cash flow generation. Or they trade Tesla stock because of its dominance in autonomous manufacturing and retail brand loyalty. Those companies are the cornerstones of modern institutional portfolios, heavily featured across Fidelity Investments portfolios, Fidelity mutual funds, and managed individual brokerage holdings. But those massive names trade at astronomical valuation multiples, where a lot of future growth is already entirely priced into the current stock price. A microcap like BigBear.ai trades at a fraction of those valuations because the market views its reliance on government contracts as a structural weakness rather than a predictable revenue stream. The underlying reality, however, is that while consumer spending can dry up in a recession, defense and national security spending are practically guaranteed to grow regardless of economic conditions. Looking back at the historical performance of this asset provides critical context for why the market is so hesitant today. The company originally went public in late 2021 through a merger with a special purpose acquisition company, right at the absolute peak of the speculative technology bubble. Because of that timing, the stock suffered a massive multi-year downward re-rating as the initial market hype faded and reality set in regarding their actual revenue numbers and high operational costs. There were prior financial restatements that severely damaged investor trust, and the executive leadership team had to spend the last few years completely restructuring the balance sheet, cutting down unnecessary corporate overhead, and focusing purely on higher-margin software solutions rather than low-margin consulting services. CFO Sean Raymond Ricker and other corporate insiders have executed routine, calculated stock sales over the past 6 months, which often worries retail investors watching insider trading dashboards on an online investing site. However, when you look at the scale of those sales relative to the total institutional holdings, they represent standard executive compensation liquidations rather than a structural lack of confidence in the corporate trajectory. This historical baggage is exactly why the expectations versus reality gap is so incredibly wide right now. The market is pricing the stock based on its messy past, while the current data reflects a completely different operational reality. The company's Ask Sage platform is quietly becoming a standard for secure generative software deployment within classified networks, allowing federal employees to leverage advanced data analytics without risking data leaks. This is an incredibly sticky business model. Once a software platform is integrated into the core IT infrastructure of a defense agency or the Federal Aviation Administration, the switching costs are astronomical. It takes years to clear the security protocols required to handle that data, giving BigBear.ai a massive structural moat against newer, well-funded commercial competitors who lack the federal clearances and domain expertise required to win these specific accounts. As we look toward the future outlook and potential scenarios for this asset, everything comes back to how the company executes on its current $281.9 million backlog. If they can successfully convert those contract wins into high-margin, repeatable software revenue over the next 12 months, their gross margins will continue to expand from the current 34% toward the 50% range typical of mature software businesses. This operational pivot is the ultimate catalyst that could force a massive reassessment of the stock's valuation. Conversely, the risks are equally clear. If the company experiences project delays, encounter further legal friction from legacy class action lawsuits, or fails to manage its cash burn effectively, the heavy short interest will continue to suppress the stock price, forcing further retail capitulation. For investors navigating the space via Fidelity brokerage services, interactive brokers trading accounts, or SoFi active investing options, the asset remains a high-stakes battleground where short-term technical chart patterns are constantly colliding with long-term fundamental shifts. The entire thesis for BigBear.ai hinges on this exact divergence between what the casual market expects and what the operational reality shows. The market expects a slow, debt-burdened defense consultant that is vulnerable to microcap volatility and retail panic.
The reality reveals a company that is systematically cleaning up its financial statements, narrowing its net losses, expanding its contract backlog by double digits, and embedding its proprietary software directly into critical national security and global trade infrastructure. It is a highly volatile, heavily shorted asset that requires a deep understanding of corporate restructuring and federal spending cycles to accurately interpret. By anchoring your analysis in actual intraday trading volumes, institutional accumulation patterns, and recent contract data, rather than outdated past performance narratives, you can clearly see that the underlying structural shift is moving much faster than the public stock market price currently reflects. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, subscribe for more updates.